everyone, welcome back to another episode of AWM Insights. It's your Power 3, 2 CPWAs and a CFA. We're Erik, Brandon, and Justin, and welcome to 2021. We are every week breaking down what you need to know from the investment world to help you capture the returns that you deserve. And to say that 2020 was a wild year is an understatement. We saw the S&P 500 drop 33.9% before ultimately ending the year up positive 18.3%. Small caps, which everybody in the financial media declared was dead, actually outperformed the S&P 500, ending up the year 20%. And then, of course, we would be remiss if we didn't talk about the darling of the dance, Bitcoin, finishing up the year 304%, but not on its way without an insanely bumpy ride. At one point, it was down 52.4% in 2020. And so today, we're going to discuss how the 2020 markets should impact your investment decisions going forward. But before we do that, we want to jump into the details. We want to talk about today's Georgia Senate race, which comes just one day ahead of a joint session of Congress to certify the Electoral College vote. And we'll see if President-elect Joe Biden's victory is actually cemented.
Yeah, well, there's two big items you just mentioned that we got to talk about before we reflect back on the year that was. Georgia and like you said, the joint session of Congress. I expect to see some volatility this week for sure. There's no question that uncertainty and challenging a smooth transition of the office of the president, let's say it that way, is not something markets probably will take lightly. Let's hope I'm wrong on that. It's always super difficult to predict exactly how markets will react to these things, but certainly uncertainty is not something markets like. So couple interesting days ahead for sure.
Yeah, it's going to be really interesting, Justin. I mean, right, the prediction in the short term, how hard is that? Yesterday, we saw a big sell-off. This morning, we're up. I definitely got the text yesterday, hey, are we seeing a sell-off? And I'm glad my answer is always, hey, your guess is as good as mine. And this is certainly why we play the long game, because who knows what the heck's going to happen. We've got a president that's I saw the quote, vowing to fight like hell to stay in the White House. That could end up being an interesting thing for markets for sure.
Now, I think that you bring up a good point, Brandon, is we see that sell-off a little bit on Monday. Now, there's also been this big conversation of 2020. It was crazy, but we see these positive returns. Clearly, there's this belief that we're just, bringing in all the optimism of what could have happened in the forward, and things are overvalued, right? Like, should we move cash to the sidelines? How much should what happened in 2020 impact what we do in our portfolios in 2021?
Well, the short of it is it shouldn't impact what you're doing at all. Really, there's no correlation between what markets did in a previous year with the new year that we're turning into. That being said, you've touched on valuation and things like that. Those are potential considerations that may have a little bit more merit, but you can always see both sides of those arguments as well, right? A lot of people say, hey, stocks are overvalued right now because price to earnings are at extended levels. Well, combine that with low interest rates, and there's a good rationalization for higher valuations, right? You just never know exactly how markets are going to react. And even if they are overvalued, how long will they remain overvalued, right? Timing these things is incredibly difficult, and getting it right on both when to sell and then when to buy back in. I mean, right, that's almost impossible from a probability standpoint. So going back to your question, though, I think it's really important to take away that, hey, whatever happened in 2020 is gone. Markets really don't care about nice, neat 12-month periods of time. It's nice for us to reflect and learn from it for sure. And 2020 was full of great experiences to remind us why we're invested, to highlight why we do certain things. We're going to talk about small caps, I assume, at some point today. And so it is important to look back and reflect and take little nuggets here and there, but know that it doesn't mean hey, markets are going to be negative this year, or markets are going to underperform what they did last year, or outperform for that matter. We just don't know.
And one thing I want to hit on real quick is what you said is the arbitrary time frame of a year in returns, right? Is we can unfortunately allow financial media or even just the system of the financial world of quarterly reporting all of a sudden start to make you as the investor feel like I should be benchmarking to these arbitrary dates, when in reality, I need to take a step back as an investor and say, what are my priorities? What are my timeframes? For a lot of our clients, we're planning for multiple generations. We're not even worried about not only 12 months, but really how do we transfer this money to our future kids and their kids' kids with the type of wealth level that we're talking about. And you can really hurt yourself if you start to make short-term investment decisions on arbitrary timeframes as opposed to what your customized benchmark should be.
Yeah, I think that's a great point, Eric, because at the end of the day, like you mentioned, you shouldn't be doing anything if you understand what your priorities are and your portfolio reflects those priorities. Because I would say that's also a big disconnect that we see in the industry is, you may go through a goals-based planning process, but then the implementation doesn't reflect that. So you want to make sure that the implementation is reflecting a sense what your priorities are for the long term. Okay, if we're going to put money away for the long term, all this short-term noise doesn't really make a bit of difference unless my fundamental belief has changed that markets and economies are going to grow over time. Then I don't really care what it's going to do in the next couple of weeks. Where you get yourself into trouble is you're trying to trade some sort of event, or you've put yourself in a position where your investment portfolio is misaligned with your priorities. For instance, you're approaching retirement and you've been in a mostly equity portfolio, and now all of a sudden, you don't have a protective reserve to fall back on, and you're worried about correcting markets over the next couple of weeks because of some political event. Yeah, guess what? You didn't do the proper planning. You didn't identify your priorities, and most importantly, you didn't implement in a proper way.
And Justin, I'll let you talk about this, but the velocity of the change that happened in 2020 and the importance of, most of the returns come from a long tail event in a very short amount of time. I'd love to hear you talk a little bit about small caps, why it's not dead, how this shows up, and why we at AWM aren't surprised by the information that we're seeing.
Yeah, I mean, the volatility kind of across the board was astounding last year, and specifically in March of last year. To your point, the speed at which markets melted down and then recovered was truly unprecedented. I mean, we lost the most amount in, I think the S&P 500 in the shortest amount of time. But focusing specifically on small caps, right, where they're a riskier asset class. We favor them kind of because they're a riskier asset class. We expect a higher return from them because they are slightly riskier. But 2020 just underscored that consistent exposure to that asset class and not knowing when outperformance will happen. It came fast. It came swift. It was really unpredictable. I mean, 2020 as a whole was unpredictable, is a perfect example of that. But it just underscores, hey, staying invested, keeping exposure to these areas of the market that give us some higher expected returns, small caps being one of those, because we don't know when it's going to turn. When it does turn, it turns fast. Like I said, it turns hard, right? I mean, the amount that it did appreciate from trough to peak, if you will, was just astounding. I think it was close to 100%, if memory serves me correct. And so just trying to time these things, not only, again, we've underscored tops and bottoms is almost impossible, but when it's going to happen, right? Like just saying, hey, on March 20th, we know that that's going to be the bottom. It really, really, really impacts your overall compounding of wealth going forward if you're going to try and play that game. Because if you miss out on that 1 day or that 2 days or those 2 days of really, really strong performance of, almost 5 to 10% in some cases in small caps, you're going to miss out on some pretty big returns.
And talking about missing out on big returns, I think everybody's conversations, if you're in the investment world, are involving the conversation of Bitcoin. Once again, this is not a new conversation. On our previous podcast before we turned over the year, we talked about cryptocurrency's been around since 2008. This is something that we've paid attention to for a very long time. But here it is showing back up in the news in 2021. Clients are calling saying, hey, should I do this to diversify? Should I do this to lower my risk? Would love to hear your guys' thoughts about where Bitcoin does fit inside of an investor's investment plan, and how they should be thinking about this as they approach 2021.
Yeah, I mean, I think from my perspective, when you talk about investments, right? How do you evaluate an investment? You have to be able to ascertain some sort of idea about what the potential return could be for that. And so, I always ask the question, okay, you think Bitcoin's going to $1 million a coin. What justification do you have for that? If we said, hey, Apple's going to go to $1 million a share, right? We could put together a plausible argument of, hey, Apple generates this amount of profits, and based upon this profits, there's some sort of multiple, et cetera. And you could extrapolate a value. I think where it becomes really difficult with something like Bitcoin is that there is no cash flow. There's nothing to evaluate there. And so the argument becomes a currency replacement. It's going to, the dollar is no longer going to be our reserve currency, and we're all going to move to Bitcoin. Okay. Or there's a limited supply, kind of the gold argument, right? There's only so much out there. I think we covered this on the last podcast. There's actually more out there than people realize because of the fractional share piece of Bitcoin. But, I think when you look at that and you start to answer those questions, I think it should quickly start to materialize that, hey, you know what, this isn't really an investment. This is more of a speculation. And it doesn't mean that you shouldn't go buy some Bitcoin. I think you just need to understand why you're buying it. And it ties back to your priorities and your outcomes. So, if going and buying some Bitcoin isn't going to impact your priorities or the likelihood of positive outcomes, and you want to have it because you think, hey, this might be exciting, this might be a good ride. I don't want the FOMO. I don't want my buddies in the clubhouse or at the gym or at the golf course saying like, hey, I hit the lottery with Bitcoin. Then I think you can do it. I just would remind people, those same people oftentimes are the ones that aren't telling you about the losses they had. And you better be ready. Last thing I'd say is just be ready for the volatility. We saw that last year. There aren't too many people out there that can watch their money go down by 52% and hang on. So it's just making sure that you're ready. I mean, even some of the most bullish Bitcoin people out there, Raoul Paul, look him up on Twitter for anybody. I mean, he is one of these guys that's saying, Bitcoin could go to $1 million a coin. But if you look in the details, he fully expects a 60 to 80% correction at some point. He acknowledges the argument we just talked about. The hard part about that is it's impossible to time it. So you better be ready for your 100,000 or whatever amount of money that you're putting into Bitcoin to significantly decline at some point.
And I think the important part there that, he even points out is a large part of your success is, are you able to stay in the game? Are you positioned appropriately to withstand the volatility for your investment plan to work out to achieve whatever you define as success? And one of the most dangerous things we can do, and the biggest mistakes as investors, is risking money that we already have in our pocket that we actually need to accomplish our priorities, is taking that money and investing in something that is highly speculative that probably isn't going to materialize in an amount of money that's going to change our life, but it will absolutely hurt us if we lose that amount of money. And so that's really where we caution people. I think the other thing that we talk a lot about is when we sit down with our families is a reminder that as an independent family office, we're completely agnostic to what investment is going into your portfolio. Our compensation doesn't change whether it's venture or private real estate or Bitcoin or public equities. It's really just our job as your fiduciary to say, what are your priorities? All right, based off of that, here's the historical evidence that lays out based off of how much risk you're going to take. Here's the return that should really be compensated to move you to achieve those goals. And I think that's vitally important is to understand that you have to clarify what your priorities are and not try and invest on what are the exciting trends going on in culture.
Oh yeah, no doubt about that. I think that's a great summary, right? You have to right size your risk exposure, but do so by taking into account your priorities and your desired outcomes first and foremost. And then, to Brandon's point, if you have an itch to scratch with respect to Bitcoin and all that other stuff is taken care of, hey, it starts to make, some plausible sense some logical sense, plausible sense, whatever you want to call it, to add that to a portfolio. Is it prudent? We can maybe have an argument on that. I'm not sure. It depends on what size you want to do it. Again, that goes back to right sizing your risk exposure with respect to some of these more speculative allocations.
Yeah, and so as we enter into 2021, hopefully the takeaway for you guys is, first and foremost, as everybody's setting aside what are their goals and their priorities, maybe for their careers or their families, you need to do the same thing with your money and with your finances. It's really defining what are your priorities, what's the life that you've envisioned, and then based off of that, you start to choose investments that historically have evidence-based backing that says this is going to give you the highest confidence to achieve those priorities. Because once again, the biggest mistake and regret that we could have as investors is saying, you know what, I had an opportunity to achieve my priorities, but I got distracted because of FOMO. So I took money that I needed, that I was actually on a great trajectory, and I started to reach for more, and I risked my family's priorities. And so we really encourage you to head over to awminsights.com, where you can access all of this in the show notes. And we'd love to hear from you. What are the questions that you guys have that you want answered in 2021? We'd love to hit on those. But until next time, stay humble, stay hungry, and always be a pro. The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.